Welcome to lesson 8.4, purchasing a home. This is probably my favorite one because it makes people's dreams come true. So understand that you need to acquire the lexicon in real estate for you to really understand what's going on in this chapter. A lexicon is like a specific little vocabulary of words in an industry. So if I'm talking to a welder and they're using welding terms, I have no idea what's in their lexicon. I don't really understand their language, just like I wouldn't understand a doctor's language and so forth. So every industry has its own lexicon. So let's jump into the vocabulary so that you can understand what real estate people are talking about. Alright, first vocabulary word is called recurring costs. Recurring is in the word, right? It's going to happen over and over again. These costs occur on a regular basis, like a mortgage payment, like insurance, and like taxes. Now, some of you might be thinking, well, what if I pay cash for my home? I won't have a mortgage payment. That is no longer a recurring cost. You're absolutely correct. However, I do suggest you keep the insurance on the home and see what happens if you stop paying your property taxes. No, actually don't. What'll happen is that they'll come after you, maybe even force you to sell your home. So even though you own your home free and clear, ultimately Uncle Sam owns your home. You still got to pay property taxes on it. So recurring costs are costs that occur on a regular basis. All right, then we have non-recurring closing costs, right? That's our next vocabulary word, non-recurring closing costs. And these costs do not recur. So this is a one-time cost, like closing costs in a transaction, attorney fees, recording fees. These are one-time fees that you pay when you're purchasing the home, and they're not going to happen over and over and over again. What is a closing? A closing, which is our next vocabulary word, by the way, a closing is a meeting attended by the buyer, the seller, the attorney, a representative from the lending institution, and it's where the official sale takes place. Now, in the state of California, we don't have these kind of closings. We use an escrow company, but in other states they do. And so a closing is when the official sales take place. You finalize all the paperwork, everybody signs, money's exchanged, done deal, right? That is a closing. Now, there are costs associated with that. That is our next vocabulary word, closing costs. And these are all fees associated with the purchase of a property. The buyer is responsible for paying these costs, these closing costs. And these could be things like transfer tax or notary fees or escrow fees, attorney fees, all kinds of closing costs associated with this. Normally, the buyer is responsible for paying those types of closing costs. Next vocabulary word is earnest money deposit. Now, in real estate, we get a little lazy like any other industry, and we don't like to call them earnest money deposits. We call them EMDs. And this is a good faith deposit paid by the buyer to the seller to show they're serious about buying the property. Now, in the state of California, when you have a contract, it's not enough for you to have terms on a piece of paper and signed. Often there has to be some sort of consideration to make that contract in effect. The earnest money deposit is a form of consideration along with the contract between the buyer and the seller signed by both parties, and now the contract is pretty basically activated, right? It's on. Send it to the escrow company and we're off and rolling in the process of buying or selling a property. Earnest money deposit. All right, next vocabulary word is attorney fees. Now, these are fees paid for representation at closing. So in other states, the attorney can show up for you and get all the paperwork done and you close and it's a done deal. In the state of California, we rarely use attorneys for real estate transactions. We can, but we don't usually do. We use an escrow company. But these would be the fees paid to the attorney. All right, next one is origination fees / points. Now, money is paid to the lending institution for processing paperwork and or the use of the money being borrowed. These are origination fees. The bank is a business like any other, and it's going to make money every single step of the way. So when they start the application process, the mortgage process to get the paperwork started for you to even borrow the loan, they're going to charge you for that. These are called origination fees, and they can be charged as points, and we'll talk about what points are in a second. All right, next vocabulary word we have is title. Now, title is the legal claim to claim of property ownership. Now, when you buy a property, when me as a real estate agent goes out and represents a seller to sell their property, one of the first things we do is called a title search. We want to make sure that the person that we're doing business with is actually the person who can sell the property. It's not their parents' home or their company's home or their friend's home that they're trying to sell. So we do a title search to see if this person is the person who has a legal claim to the property. And if they do, then they have the right to go ahead and sell the property. They have title. They have the right to sell or transfer that particular property. So that's what title is. All right, next vocabulary word is points. Now, these are fees that are charged to the buyer from the lender. 1 point is equivalent to 1% of the loan amount. So if you're in California and the average fee of a home is $500,000 and you get charged 1 point, you got charged $5,000. If you're in the windy city of Chicago and the average sale price is $200,000 and they charge you 1 point, you're paying $2,000. So points are fees that are charged to the buyer. Sometimes you get to the buyer from the lender. Now, these are sometimes charged in quarter points, or half a point, or a point and a half, but 1 point is equivalent to 1% of the purchase price. So when we were talking about origination fees, they can charge you a fee or they can charge you a point. Both ways they're charging you. Now we have discount points. Now these are points paid to reduce the interest rate of a loan. Normally loans are reduced at a quarter point at a time. So let's say that, like, for example, today's interest rates are at about 5%. Now I don't want to pay 5% mortgage APR on my mortgage. I want to lower the rate. The bank may give you the option to come to the table with money up front and buy down that rate. So let's say you put in an extra $5,000, then it'll knock down a quarter interest rate. Now your interest rate for the life of the loan is 4.75 instead of 5. Maybe you bring another 5,000 or another 3,000, they knock down another quarter point, you're at 4.5. So you can get these discounted points and lower your monthly payment by coming up to the table with cash up front. All right, so that's discount points. Next vocabulary word we have is transfer tax. Now this is a fee paid for the transfer of title from seller to buyer, or from owner to other owner. So when you go to the assessor's office and this gets done, whether it's a trust deed sale, whether it's a quick claim, or whatever it is that you're doing, when you change title from one person to another, from one entity to another entity, the assessor's office is going to charge you a transfer tax. All right. Next is the amortization table. Now this is a list of unpaid principal and monthly payments, and the amount allocated to interest. So here's how it works. You have multiple columns in this amortization table. It'll tell you what payment number you're on. The next one tells you your beginning balance. The next one might tell you your total monthly payment. The next one might tell you how much of that monthly payment is principal, which is paying down what you owe. The next column might tell you how much is interest, which is the profit that the bank is making. And then the next column might be any additional monthly amounts that you're paying. And then the last one will be the ending balance for that particular period. And it's basically all 360 payments for your loan listed in detail, how much is being split to what. So you can look at any particular monthly payment and see exactly where you're at in your mortgage. All right, the next vocabulary word is interest rate. Now this is the rate lenders offer you, and it stays into effect for a given period of time. So the initial rate might only be good for 2 weeks, 3 weeks, 4 weeks, whatever it is. So when you're getting your loan, if you find a place and close escrow within that limited time, they will honor that rate. But after that time period, the rate could go up, the rate could go down. It's just depending on where the market's at. But they'll give you an initial rate for an initial period, for a given period of time. Last one we have is the adjustment period. The adjustment period is the period between rate changes and interest rates and monthly payments. It's where your monthly payment may change, So we were talking about adjustable rate mortgages in a previous section. You might have a fixed mortgage rate for 3 years or 5 years or 7 years, and your monthly interest rate and your monthly payment will not change. But after that time frame is up, then it's going to change based on whatever the interest rate is in the market, plus or minus a cap or whatever it is that is written in your contract. And as such, your monthly payment will change during that period of adjustment. That's called the adjustment period, when the monthly payment or the interest rates begin to change. All right, let's get into example number 1. Mila and Liam are buying a $600,000 home with an APR of 7.25% and have made a 15% down payment. They are set to close on September 6th. how much will they expect to pay in prepaid interest at closing? Now you got to understand, first of all, which days of the month have 30 days, which days of the month have more. So if you hold your hand in a closed fist and you start with your index finger's knuckle and you move all the way to the left, make sure that every month you go in between the knuckle and then the knuckle, in between the knuckle and then the knuckle. You can start with January in the knuckle, February between the knuckles, March on the knuckle, April between the knuckles, May on the knuckle, and then June, and then July gets a knuckle, and August starts all the way back over, it gets a knuckle too. And if you use this process to start January, February, March, April, May, the months that land on the knuckle are 31-day months. The months that land between the knuckle are less than 31 days, so there'll be 30 days except for February. So that, first of all, understanding which month has 31 days is important for this problem, because, for example, September is a 30-day month, and you close on September 6th, so you have 24 days there that you're going to have to calculate on prepaid interest. See, what happens with mortgages is you have to hold the money for at least 30 days before you make your first monthly payment, and that monthly payment will take into account the interest that has incurred while you've been holding that money. Rent, on the other hand, you pay it for the next 30 days. So you pay it ahead of time to live in a place for 30 days. Whereas mortgages, you pay backwards. You pay interest on how long you've already held the money. So we need to calculate 24 days of interest for this problem. So here's how it works. First, we need to figure out how much money we borrowed. So they're buying a house for $600,000, but they put down a 15% mortgage, or sorry, for 15% down payment. So that means they borrowed 85% of the purchase price. So if I take $600,000 and I multiply it by 0.85, I'm going to get $510,000. This is how much they borrowed from the bank. Now they borrowed that at a rate of 7.25%. So I'm going to take my $510,000 loan, multiply it by 0.0725, and I come up with $36,975. Now this is the interest that I'm going to pay in my first year of the loan. So if I break that up into 365 days, I can see that I'm going to pay $101.30 in interest per day as I hold this loan. So I need 24 days till the end of September that I need to prepay in interest. So if I multiply that $101.30 by 24, it means that I'm going to prepay at closing $2,431.20. All right, let's move on to example number 2. How much will Mila and Liam need to pay in total at closing? So when you're buying a home, you need to have a general idea. So when you're on the buying side, you need to come with your down payment, and then closing costs range generally between 2 and 7% of the purchase price. So they're buying a home for $600,000. So if their closing costs, if they can get them down all the way down to 2% in closing costs, then 2% of $600,000, that's 600,000 times 0.02, is going to cost them about $12,000. If their closing costs are higher, depending on where they're at, what state, where they live in, where they're buying, so forth, then 600,000 times 0.07 or 7% is going to be $42,000. So when Mila and Liam get ready to close, they need to come to the closing table with their checkbook ready and prepared to write a check for anywhere between $12,000 and $42,000 at closing on top of their down payment. So you got to make sure you have that money put away, ready to rock and roll when you're ready to buy a home. All right, last one, example number 3. James and Vanessa have been approved for a $300,000 15-year mortgage with an APR of 5.75%. How much of their first monthly payment goes towards interest and principal? So in this problem, we're going to manipulate some things. That equation that we got to, now you know what, we're going to keep the same equation. So we're going to use the equation that we used in previous chapters, that big old long one. M is equal to the principal, in this case it's going to be 300,000, times the rate, which is 0.0575 divided by 12, close the parentheses, open the parentheses, 1 plus 0.0575 divided by 12, close the parentheses, raise it to 12 times. Now this is a 15-year mortgage, so 12 times 15 all divided by 1 plus 0.0575 divided by 12, close the parentheses, raise that to 12 times 15 minus 1. So we're going to use the graphing calculator, and when we do that, we figure out the monthly payment for them is going to be $2,491.23. Now this is the mortgage, or this is the monthly payment, which includes principal and interest. So I'm going to use the equation I is equal to principal times rate times time, right? And I'm going to figure out what the interest portion is of this payment. So I'm going to plug in the 300,000, the 0.0575, and I'm going to plug in the 12, the interest rate amount and the time amount. And I'm going to calculate here that this total amount is going to be $1,437.50. That's the interest portion of this loan. That's the interest only section. So if I know the total amount is $2,491.23, subtract that out from the interest portion, I know that the principal is going to be $1,053.73. And remember that this question was asking us how much of their first monthly payment goes to interest and how much of it goes to principal. So now we have both pieces. The total payment is going to be $2,491.23. The interest portion is $1,437.50, and the principal portion is $1,053.73. And these are the types of breakdowns that you're going to see in an amortization table. That's all we got for this one. So remember, when you're getting ready to buy a home, there are a lot of factors that go into play. How much do you need as a down payment? Do I qualify to buy a home? What's my debt to income ratio? There are a number of questions, and it's always a good idea to seek out a professional who is in the industry. So send me an email, hernan@csfirst.com. If you have questions, I would love to help you get you in a home, and at the same time hook you up with some professionals that'll help you find the best mortgage solution for you. So hernan@csfirst.com, and as always, check out our podcast, Business Bros. You can find it on iTunes or anywhere where you listen to your podcast. We'd love for you to listen to our daily 30-minute motivational Mondays, or anything you do on Tuesdays, or get over the hump Wednesdays, whatever it is. We have a daily podcast, 30 minutes a day for you to learn a little bit more about the business world. So that's all I got for you guys today. Peace, and I'm out.